And so I would probably argue that the last 5 years, the 13 odd billion was just in AI speak training data. And now we're moving to actual deployment models, which should be able to create a lot more value. Now, the challenge, which was always very predictable, in part because if you've been in the venture market and venture business as long as I have, and you've seen sort of economic cycles, you realize that a lot of the behavior of the foreign investors was so predictable. It was as predictable as the sun rising, right? The 0% yields allow people to take more risks. They empower people to take more risks in the search for yield, right? And what we then found was everybody kind of thought, oh my gosh, they love this market. And what it really was like they're just looking for yield. And the minute everything turned, they're like, oh wait, we've got, we should really pay attention to things that are closer to home. And so I think, for us, if there's sort of a couple of material observations, one is that we are, when the US 2 year or 5 year or 10 year catches a cold or sneezes, we're going to catch a cold, right? And so we are so dependent on how people think of risks. And a lot of that is just going to be sort of what your riskless returns look like in the US. And there's a whole back and forth around, oh yeah, the rates are going to get cut and this and that. And so you can see this baited excitement, like, oh, we just need, it's almost like, you go into like a Greyhound race and you see how they act right before the gates open, right? Everyone's like, we're going to wait for these rates. And once these rates get cut, and the Fed look at you guys and be like, you don't know about all that stuff, we're seeing some strength in the US economy and all that good stuff. And it's an election year as well, which sort of means all bets are off. So, you know, one of the things we used to do, and we seem to have gotten lost, and I'm hoping that we sort of get back into it, is become sort of not just more self-sufficient, and I think we're sort of naturally resilient, but also sort of figure out how to be more collaborative because no one's coming to save us. Right. I mean, they come, they chat, this and that. No one's coming to save us, right? And all of the stuff about how, venture is moving to oh, you need to be profitable. I think it's all nonsense, right? Because venture has never been about trying to invest in profitable companies. Venture has been always about high growth, right? Steep ascents, you can sort of figure out how to maintain growth at the expense of profitability for a while. And so you now see sort of this, almost schizophrenic approach to, oh, you need to switch from high growth to profitability. We used to be very good at that in Africa, right? We used to be really, really gifted at sort of never expecting there was going to be another dollar once the dollar came in, and figured out how to make that dollar, $5 or $6 or $7. And why I think this panels like this are important because we're sort of looking backwards now, but we really need to be thinking about looking forwards. Is that we're now in a macro environment that is unbelievably difficult for both founders and funders in quite a few countries in Africa. Right? I mean, I'm sure you're following what's going on in Nigeria. 2 weeks ago today, I shared a tweet about how founders need to sort of go and completely recast their forecast for fiscal year 24. Because whatever it is, whatever exchange rate you used, I was like, look, I'm projecting an exchange rate of 1,950 naira to the dollar by the end of the year, right? That was 2 weeks ago. 2 weeks ago. So today, the last trade was that I had heard of was 1554. So I'm sitting there going, okay. And when I sent out that tweet, it was 1336. So I'm like, look, by the time it gets to Valentine's Day, this thing might be at the 1950 that I thought, so I made some joke about roses are red and so and your eyes will be too. But, it just sort of, and you see challenges like that in Kenya and some of these big markets in Egypt. So all the big four that everybody keeps talking about have significant headwinds, right? And so I don't know if that macro even suggests that 2024 as a fundraising year will be anywhere even remotely close to even 2023. It's just going to be harder, right? And so, and then part of what I think I want to learn from this panel is sort of, what should founders be thinking? What should investors be thinking, right? How do you, how should they navigate what I call the Drake passage, right? Which is, as some of you may know, is one of the toughest sections of sea that a ship can go through. Um, there's so much, right? And I think people are really looking for direction. And I do think that, anything that we see has happened in the past, we just need to sort of move past that and say, okay, what does the future really look like for venture and investing in Africa? And I think the final thing, just my final comment is that Nathan, you talked about, I mean, I'm so physically ill when I think about what you said. For every dollar a male founder raised, a female founder raised 7.6 cents. Okay, so I think that a lot of the losses that will come out of the 5-year investing dollars that showed up probably has a direct correlation with the mismatch in gender investing, right? And that's another thing we need to talk about because we have not really struggled with our female founders, right? And the businesses, they may not grow as fast, but you tend to sort of start to see what they can eventually become, which is annuity businesses. And I mean that particular stat still is making me ill. But it's something that's worth talking about because I've said this on the WhatsApp groups, things just need to fix, need to change. And doing the same thing over and over again and expecting different results is just a pill it's an insanity pill. And that needs to end.
Iglesia, thank you. That was lots to unpack there, and thank you for that valuable answer. Dr. Ola Brown, firstly, welcome, and would you kindly introduce yourself? And also, my question to you would be to pick up on what Igosa was saying, is that on the gender diversification and investing more into women account for more than 50% of Africa's population. And just to add another stat to what you were saying, 1 in 4 women starts businesses and manages businesses in sub-Saharan Africa. So what needs to happen for more investment to go into female founders? Is it pipeline? What is it? Over to you, Dr. Brown.
Hi, my name's Ola. I'm GP at HealthCap. HealthCap is a venture firm that invests in 2 verticals only, health tech and fintech, and we focus on Africa's big markets in Nigeria, Egypt, Kenya, and South Africa. Nice to be with you all, and I'm looking forward to an interesting conversation. So the question you asked is mainly about female founders and how to get money to female founders. So I think the first thing that I'd like to point out is that actually Africa is the only continent in the world where a woman is more likely to start a business than a man. So if you look at Europe, men are more likely to start businesses. If you look in North and South America, men are more likely to start businesses. Even curiously, in Asia, where I thought, a lot of particularly Chinese, Thai women start businesses, still men are more likely to start businesses. But in Africa, women are more likely to start businesses. So mathematically, it makes even less sense when you look at the statistics for female-founded businesses in Africa than it does in the rest of the world. And so how do we go about changing that? I don't necessarily think it's a pipeline problem because HealthCap was never a gender lens fund. So we never set out to fund more women than men or fund an equal number. We didn't have that as one of our sort of assessment criteria. But we still ended up with a portfolio that has 50% female founders. So I think it's about being very, and we were not intentional actually about looking for female founders. We weren't intentional about looking for a female pipeline at all. It was just the deals that we thought were the best fintech and health tech companies on the continent. So I think that, being aware of some biases in VC, and I'm going to cite a Harvard Business Review article that cites research that was actually conducted in Sweden, where when female founders came to pitch, they did the research and they asked the female founders to use exactly the same words and the same style of pitch as the male founders. But when they assessed the phraseology, for exactly the same phraseology, women were seen to be arrogant or overconfident, whereas men were seen to be, and I'll link for anybody watching, sorry for the people on YouTube, but for anybody watching here on Zoom, I'll link the study in the chat so you can have a look at it because it's so interesting. And for anybody watching on YouTube that can't see the chat, then I'll also put the study on my LinkedIn again so that you can have a look at it. But yeah, for exactly the same phrases, men and women were founders. For a Swedish VC, where it's very egalitarian society, we're judged very differently. So I think that that's something that we all have to bear in mind in our industry. That I don't think it's a reflection of the type of businesses that women are building necessarily. I don't think it's necessarily a reflection of the resilience of those businesses because there's no evidence around exits, there's no evidence around sort of other metrics to show that women's businesses are less successful. But I think it's about the things that we hold in our mind and our assessment criteria. And I think some of these gender lens funds that are coming up are good because they have that as part of their investment criteria. But I think in order to really, really sort of exponentially increase the number of women coming through the pipeline, it can't be up to gender lens funds alone. And actually, I think that it's more important for everybody to be in the venture industry to be aware of the intrinsic biases that perhaps we hold when female founders come to pitch to us, and perhaps once we're aware of them, then we can start to challenge them internally, particularly with our investment committees, and maybe having sort of again, this is data from Forbes, where they looked at having a female investment committee member or having a female GP. Can you believe that drastically increases the amount of women funded? So a female GP is, I think it's 20 to 30% more likely to fund a female founder than if it's an all-male team, including the IC. So some of these subtle changes that we can make, and both of our external IC members are actually women at HealthCap, so I don't know whether that's contributed, but definitely trying to make these changes, maybe external IC members, maybe even some of the LPs can start pushing us slowly towards a situation where we're not just funding sorts of companies because in order to fund the best companies, there has to be that level of diversity. I mean, if we're saying that women do start more businesses than men in Africa, then it makes sense that a greater proportion of the best companies, not necessarily female-led companies, but the best companies that are going to grow and are going to exit and are going to create economic growth and are going to create jobs are going to be female-led.
Thank you. Karen, I want to know from the Catalyst Fund and your perspective, is it just removing the bias, as Dr. Brown suggested, and also having women both sides of the table? What has been your perspective on this?
I think other than just removing the bias, I think it has to be an intentionality in how we make our investments. Our team is majority female-led. Our IC is majority female. I think other than the fund manager having more gender diversity, one of these that will be able to sort of move the coin on this is LPs actually having a requirement for their GPs to be able to deploy a certain percentage to female-founded or co-founded companies. For Catalyst, we have a 40% requirement that every 40% of our portfolio has to be female-founded or co-founded. We're currently at 35% and pushing to increase that to our minimum threshold. But I think it makes a huge difference, even speaking to some of our female portfolio companies. I think some of the questions that they get asked are ridiculous in different fundraising conversations. And male founders would never be asked the same kind of questions. And as a woman, you sort of can see that because in different aspects of your life as well, you also get some of similar questions as you go about your day-to-day investing. So I think that it has to be very intentional. I think this one LPs also have to play a huge part because it's still, and I guess I'm really happy you brought it up. It's actually still it's one of those things that at this stage, at this point, I mean, is ridiculous.
Cool, thank you, Karen. In terms of sectors, so we saw that last year fintech continued to attract the most amounts of funding with over $1 billion invested on the continent. Igosa, could you maybe walk us through which sectors do you expect to have the most amounts of growth in 2024?
Yeah, I think, some observations from sort of the sectors that we saw. There was just so much excitement in fintech over the years, and I think, those deals were getting written up, marked up very quickly. So everybody's sort of, in the classic sort of phraseology of why do you rob banks? Because that's where the money is, just, went and said, let's go rob some banks. But then, we absolutely got into this, trough of disillusionment regarding fintech. A lot of investors that had gotten super excited learned to their utmost chagrin that, one, it's actually more regulated than they thought it was, or maybe they never thought about it. Two, it was going to be more expensive from a dollars raised perspective to get these companies to sort of, escape velocity. And I think a bunch of them just got fintech fatigue. We certainly saw it in our portfolio in terms of sort of follow-on financings because people just really stopped saying, well, they were like, hey, so we're seeing deals. There was one deal they had 200K in pilot revenue, raised, 65 million total at a 350 post. And the 65 million, I think by the time they came back to market, 65 million they had generated like 1.3 million in revenue. And I think people just started saying, maybe that doesn't make any sense. Now, are the fintech opportunities done? No. I mean, I still think that there's a fair amount of fintech that can be built. But again, the question is how much risk adjusted growth can you fund these days, right? And I think a lot of people are sort of really trying to pay attention to it. But other sectors, that's interesting. I think that everything sort of around climate is going to be a big deal this year. Certainly on the LP side, I think one of the things we're a little bit concerned about is that there's going to be more money deployed into climate than should be able to absorb it. So there's going to be some concerns around there. Healthcare continues to be a very interesting sector as well. But again, it's healthcare and ed tech are very similar in the sense that a lot of the early, market feedback and a lot of the early PMF cycles don't necessarily represent the steady state. So you see a lot of very interesting things early and you think, ooh, this thing is going to blow. And then you realize, ooh, the engine has knocked. So part of what you're trying to figure out is, how do you get to steady state in some of these sectors? So healthcare certainly is interesting. I was on a call earlier on today. We talked about ag tech, very brutal sector, just trying to figure stuff out, right? You're just trying to think through all of that. And then, look, the reason why fintech continues to attract a giant share of the stuff is it doesn't require you to think too much as an investor. I mean, I'll be very candid, right? You're not going to be doing any kind of intellectual gymnastics with it. And I think, almost every other sector, struggles, with that because you actually have to do some diligence, right? Someone says, oh, I can, process X hundred millions of dollars in TPV and be like, ooh, that's great. Let's do it. What's the price? But I think for us, and we're actually going through this entire process now of how we think about the sectors for this year and the next sort of 18 months, and what's working, what's not, where things could work, where the gaps are in terms of sort of markets that have not been fully serviced. Everybody's sort of focused more on geographies, it seems these days, versus sort of sub-markets and sectors that haven't been fully serviced. Um, and and so as we sort of pay attention, we like media and entertainment. That's another very interesting sector. People always complain about consumer as everybody's like, no one wants to do consumer because it's too hard, and so on and so forth. I think that's true globally, but that said, we still like it. You just have to be sort of very, fussy about what you want to invest in. And then sort of finally, yeah, because we have some interesting things in media entertainment. But I think finally, what we would probably caution folks to do is really not about sort of the sector should be of interest. It's more about how to serve the market, right? It doesn't matter what sector lens you're using, right? These founders, these products serve the market they say they're going to serve, right? Do they do it in a consistent way? I've talked about how a founder asked me, well, how do I know if I have product market fit? And I said, well, if your customer wakes up every morning absolutely petrified about the possibility that you're not going to be in business, you have PMF. And it feels like, a lot of what we should be focused on as investors is really trying to help these founders get to that stage, right? Like I said, we're sector agnostic. I mean, we might not actually do things like ed tech because it's, as you probably heard with, Baiju's and stuff like that, ed tech just has a ton of carcasses and I can't figure out what killed them, but there's a lot of them, right? So we're trying to stay away from that as possible because, we're just not an abattoir. But it is, I think we're just very bullish. We'll see fintech, we'll do that if we like it. But we're very excited about some of the stuff we're doing in our eco fund, the latest vehicle we started. So things around climate, things around energy, things around mobility, some things around ag. We're very excited about that. And hopefully we can get more investors excited because I will say as a final point that the reason why we started that Eco Pilot Fund was because we thought a lot of investors were not interested in those sectors. And as we continue to see, as we've started to deploy the fund, more investors are just not willing to do the work and are more interested in tacking onto the momentum of fintech. And fintech's not going to save Africa, right? So it's all about that.
Cool, thank you. Dario, would you agree that we should look at which markets to serve instead of which industries are expecting the most amounts of growth? Would you agree with Igosa?
I think it's been interesting to receive a lot of the feedback. And sorry for the camera, I keep hearing patchy sound, so I turned it off so I can actually hear you guys. We've received a lot of feedback. Some people are like, I suppose the guys at TechCrunch are very interested about Francophone Africa. Some people were interested in fintech. Some people were interested in early stage funding. I think there's opportunities in certain areas, but one thing that maybe wearing my methodological analyst hat, something that I've noticed is for instance, there has been a shift, almost I would call it a gold rush towards the cash that was available for certain business models. And one of these is being, for instance, the lending model. Now, there have been companies like M&T Alan or Mancopa that were not historically lending companies, but they turn into lending companies to the point that we actually had to do a reshuffling of the data that we had because at first, the first analysis of our data looked like clean tech and super apps were getting huge amount of money. And then when we actually looked into that, we were like, hold on a minute, like there's no hundreds of millions going into super apps. This is no longer the day for super apps. There's this money is actually being thrown into a model that has picked up a lot, which has been, and we're still a year waiting to see where it's worked and where it hasn't worked, and it just dried money into lending, for instance, right? So venture money and debt into lending. So instead of saying we should focus, I'm still in a phase where I want to wait and see. I think it goes as something that raised my attention. It goes to focus more on VC than Brighter. Brighter, I want to wear a hat of someone who focuses on access to finance in general. But because I mentioned market swings beyond the VC space, depreciation, fluctuation, volatility that affect the markets. And so right now, what is happening is that we're still here trying to understand which markets are going to be resilient in this new phase, which markets are going to be able to make money, not excessively make money, but at least float over the next year or two, because it's true, like this macroeconomic condition is not necessarily going anywhere. And we're and more people are conscious about, first, the depreciation is happening in Egypt, in Nigeria, in Kenya. Actually, Zach George posted in one of the investor group quite a few months ago this whole analysis of the depreciation. It was very striking to see in bulk, like seeing all these countries that have seen their currency depreciate over the past decade. And I think having all this said, probably having system thinking when analyzing the market is important, and can get a long way. And then again, yeah. No, I don't feel like I don't feel like giving predictions of which markets to focus on. I don't think I have. Yeah, I don't wanna do that.
Maybe I could
I don't
ask
want to
the
be held. I don't want to be held accountable because I'm the data guy, and everybody like, I already said it. I'm like, no, I'm not gonna say
It's a safe space. It's a safe space. But maybe I could ask the question with better, Dr. Brown. What unique edges do you predict for the African tech ecosystem in 2024? And don't be shy, you can do anything with us.
I've actually published all my predictions. So my blog post called Time to Build is my predictions on monetary policy. And so I've just put it in the chat. So all of my predictions on where monetary policy is going to go, where I think inflation is going to go, and the opportunities and the sectors I think are exciting. So I publish my yearly predictions every year. And, some of the time I'm right, some of the time I'm wrong. But yeah, hopefully, fingers crossed, let's see how the year pans out. But I'm number one. I'm sort of predicting from the American side, actually, that rates will be higher for longer. So I can see some of the things that sort of push inflation up. Some supply chain issues, particularly with the Red Sea, some of the geopolitical instability that just makes, inflation a more likely thing and makes rate cuts or rate cuts down to the level of zero absolutely impossible. In fact, in my article, I point out that interest rates have only been zero once in the past 150 years of interest rates. So I did an analysis of the interest rates across the world, in Europe and in America over the past 150 years. And actually, zero interest rates, people are like saying, oh, it will go back to the way it was. It's highly, highly unlikely. If something has only happened in the past 150 years once, then it's highly unlikely that it's going to happen again. So zero interest rates are actually a highly abnormal phenomenon. And actually, high. That's why I'm predicting that interest rates will stay higher for longer. Maybe not as high as they are right now, but definitely not going down to zero, which means that LPs will continue to have a more sort of broader look in terms of asset classes that they want to invest in. So that's the first major prediction. The second is around the future of work. So when I'll use the Nigerian currency, when the Naira was 400 to the dollar, we actually weren't competitive with an Indian of equal skill. So India was still the major outsourcing market. At 1,000, we are more competitive. So companies like Infosys, for example, employ over 100,000 people. The biggest employer in Nigeria, Dangote, employs 30,000 people. And Infosys makes about $20 billion in terms of revenue. One company from sort of future of work, outsourcing type work. That's half of the value of the entire Nigerian stock exchange. So I think at 1,000 to 1, we're more able to capture some of that value from outsourced work, particularly in a post-COVID world where people aren't so keen with people being in their the same geographic location. That said, unfortunately, there's also been this huge sort of AI revolution. So a lot of the sort of rote kind of repetitive work that was being outsourced from the US and Europe may be replaced with AI. So in the short term, I think the future of work is an interesting place to look at, and that cuts across sectors, right? So outsourcing across sectors. But in the long term, I think, you know, some of these jobs at least may be replaced by AI, and I've put that in my prediction blog as well. But I do think the devaluation has presented an opportunity. I think the exchange rate was sort of like too high to be competitive with India at 400 in Nigeria, but right now it's very, very competitive. So Nigerian talent is attractive. And that's why I think, you know, EdTech might be interesting because there's a lot of unemployed people in Nigeria, and the same in Kenya, the same in South Africa as well. But there is a skills gap. And I think that for us to be useful in terms of outsourcing, then we need to fill that skills gap pretty quickly if we want to take advantage of probably the only advantage of currency devaluation. So that's quite interesting to me as well. Geopolitics. So one of the things that, you know, I kept on hearing was around reliance on foreign capital and over-reliance on foreign capital. And I think that is a problem because by foreign capital, we mean American capital. But what I also see, and I put that in the geopolitical section of my outlook, is the global base of power is slowly changing. I'm not saying that, you know, anything is happening to America as like, you know, or the dollar as the sort of reference currency of the world. I'm not saying that, but I'm saying that I'm seeing a geopolitical shift towards the Middle East, towards BRICS, towards Asia. And I think it's really important for us to continue to leverage some of those relationships so we're not overly reliant on one single economy and that we can diversify our sources of LP commitments. And I know that some VC companies have already started doing that. So they've started looking to the Middle East as a source of capital as it continues to establish itself as sort of a financial center of its own. And I see that South Africa also has started doing some major transactions with the Middle East. I read about as the BRICS consortium are now, you know, signing multiple trade deals and opening up sort of markets to trade amongst themselves. And I think it's important for sort of us to have options in terms of LPs as well. So we're not overly reliant on that market. So domestic capital, yes, I think that's very important. I think alternative sources of capital as well, really important. But from the founder perspective, I think what's more important is actually building or trying to build in sustainability into the business model. So you're not raising necessarily to survive, but raising to thrive. So knowing that, you know, I can raise capital at the time I want, but not out of desperation, because when you're raising out of desperation, because I've got like 2 weeks of runway left and, you know, it's going to fall apart, then it's a very vulnerable situation to for any founder to be in. And usually you don't get the best terms when you're doing that. So really planning fundraisers, but planning towards sustainability as well. So you can sort of have more choice in terms of the type of deals and type of capital you take. And I also think that even though in healthcare, at least, while things are going, you know, badly for most LPs, you know, Eli Lilly, Neurodisc, all of the big pharmas. I mean, when I was doing medical research 10 years ago, I didn't think that the biggest blockbuster drug would be an obesity drug. I really thought we'd have cured cancer by now, or cured Alzheimer's, or cured dementia, but it is what it is, right? Eli Lilly and Neurodisc have become the biggest companies on their continents, respectively, due to these new obesity blockbuster drugs, right? They are great sources of capital for health techs because they're strategic, but also for LPs or funds that invest in healthcare. So that's really interesting as well. So while traditional sources are drying up, some corporates are doing really, really well. So looking to strategic corporate capital is also something that I'd advocate, and quite a few of our portfolio companies have been able to successfully raise from corporates. That compared to sort of maybe family offices who are diversifying more into fixed income, and compared to some of the HNIs that also want fixed income, or they're piling into private credit because private credit is really hot right now, because of the interest rates, of course. The corporates are really looking for innovation. They're looking for the next growth. They're looking for a pipeline, and they're looking for strategic partners, and they're looking about how to digitalize their business models further. And that might be an interesting source of capital.
Perfect, thank you.
Right size, of course.
We are running out of time, but Karen, I would love to also know your predictions for the year to come.
I'm not going to do any predictions. I'm just going to say where, as Catalyst, what we're looking forward to seeing for the year to come. As I mentioned, we are climate tech investors and looking at different verticals within climate. So fintech for climate resilience, sustainable livelihoods, and essential services. So some of the sectors that we would like to see a lot more sort of pipeline from. Of course, our pipeline is very heavy on ag tech and Egusa. I know the challenges around agriculture, but it's one of those sectors where it drives our continent in terms of provision of food, jobs for the smallholder farmers, and all of that. So we are still going to be focused on ag and looking at different applications of agriculture and how technology comes in. I think one aspect of this is just understanding that fintech has had its time. I think even at Catalyst, we used to be a fintech-focused accelerator fund, now shifting to climate. But then we're looking at now solutions that can embed fintech within some of these verticals that we have mentioned, understanding that tech cannot be the only business model that you're driving within the continent. If you're looking at healthcare, purely health tech companies are not really doing that great on the continent. Looking at a hybrid model where you're able to have both physical clinics and healthcare platform online as well is one of those things that we're looking at. So healthcare is one of those that we're very interested in. Insurance solutions as well that are providing buffers for climate events. So disaster relief insurance, crop-based insurance relief, weather-based indexing insurance as well. So any income protection startups that are able to provide that buffer for communities, that's another area that we're really excited about. One other one that we are also, actually this particular one, if you can find that this year, would be very happy, is in the data space, something similar to a mini that came out last year. So something in data that is able to better price, the risk of these climate events, for example, you're more sort of predictive as opposed to reactive. So data, healthcare, insurtech, water is one space as well that, given the space that we operate in, there's a lot of challenges in terms of water scarcity and availability of water, and that resource actually depleting. So looking at smart ways of managing existing water resources, smart ways of monitoring those resources, and having a more predictive response towards any anomalies within that provision of water. So we're looking at a variety of things, but then those are some of the key areas that for this particular year we're trying to see more innovations coming out. Another diversification as well is trying to see, other than the big four countries that all of us are sort of concentrated on, including Catalyst, where else can we focus our investments on? So you've got your Kenya, Nigeria, South Africa, Egypt. Looking outside those four countries, we've got investments in Tanzania, in Morocco, in Senegal. Where else can we go? Benin has come out as a key player as well. I think they're now in the top 5 in terms of funding deployed for 2023. So looking at other markets outside just the main areas of concentration, so that you can diversify your portfolio as well in terms of effects from currency devaluation that we've seen in Egypt and Nigeria. Kenya is also coming up in that as well. So that other Francophone, I think, is less affected by currency devaluation, because of controversial, ways of work, like how the currency also operates. But also looking at diversification from a geographical perspective is one of those. I think we need a lot of sort of patient capital deployed in the sector especially for climate type companies. And so looking at attracting a lot more capital from an LP perspective, from a more diverse LP perspective, from local investors as well, and then looking at that diversification and geography, and then the pillars that I've mentioned as well. That's what we're looking forward to for 2024.
Perfect. Cool. Thank you, Karen. I'm just going to read some questions from the chat. So the first question would be, what do you guys look out for in founders doing pre-seed and seed rounds? So if anyone could kindly answer that. Igosa, could you answer?
Yeah, it's a great question. One of the things we've been going through, sort of the internal review has been sort of to test and retest the assumptions over the last decade about the types of founders we want to back and what they show, what they signify. And we've run into, I think, a bunch of founders, I think, certainly through ZERP, that were, raising money, as Ola would probably say, to Japan, do other things and run lifestyle businesses. And we're not in the business of supporting those types of founders. So I think, I've been using this sort of internally for a while, and I probably can share it publicly, which is that, we're really looking for founders with high agency. Right. We've also figured out very quickly what kind of investors we are. And then now really sort of trying to spend time figuring out which founders match our investing style and, best. We're not nannies. We're not going to sit down there and, and offer daycare services. We're not that type of investor. You certainly know me. I don't have time for that nonsense. But founders with high agency seem to do really well with us, right? And we seem to do really well with them. So that's going to be, I think, a key thing, right? Founders who are not sitting there waiting for venture dollars to come and sort of allow them to pursue their mission, or their vision. And then, and then founders who've done the work, I say this all the time on social media, who have you done the work required to form an opinion? So if you come in and say, oh, I want to build a product, or I've done this, I've done that, we're not really good at those types of founders. What we're really good at is, I had a hypothesis, I built an MVP or whatever it is. I went out, I tested in the market, right? I can get only one out of 10 people to pay for me, but I think I've cracked the code. I found a secret, right? We love founders that discover secrets, right? And that's going to, I think, something we're absolutely doubling and tripling down on. Founders of high agency, founders that have discovered secrets, and founders that are sort of willing to do what it takes to build a world they want to live in and they want to operate in and they want to support, versus those that have sort of read the most recent sort of thing in, on TechCrunch about some company that raised a seed fund in Asia, on Europe or in the US, and goes, oh, I want to build something like that. Let me go sort of copy the tech and do that. So we're certainly not interested in copycat founders. We want founders that have created, have sort of innovated and done the work required to form an opinion. They have an opinion. That opinion is expressed in the business model, is expressed in the product, is expressed in the market. And I think most importantly, the one thing we're absolutely not going to compromise on is we're not going to be investing in founders that have any disdain for the target markets that they serve. We see that a lot. We're not doing that. No. There we go. When I use, oh, I'm going to do some Africa on my way to go and do something in the US. No. If you don't really care about serving these markets and deeply care, then don't start.
Cool. Thank you. Dr. Brown, what do you look for in founders?
So this might be a bit of a controversial point, but we're very market orientated. So the first thing we do is actually try internally to assess the type of market that the founder is looking at, because I think that I've always been of the belief, and again, people on the panel may have different opinions on that, but I've always been at the belief that it's better to have even a mediocre founder in a fantastic market than to have a very, very good founder and just no market. And sometimes you have like absolutely brilliant founders. Like I'm sure you all know the story of the Nobel Prize winner in finance that started a hedge fund. And his hedge fund was actually so record-breakingly bad it was the first hedge fund that had to be bailed out by the Fed. Now, if you've won a Nobel Prize in finance, you should know about finance, right? You should be like, exceptional, a top 5% founder. But he just wasn't. And I don't think he sort of had a right understanding of the market or building algorithms or maybe the quant. I don't know what the problem was with the business model, but obviously it wasn't the right business. But the same founder with a great business probably would have done okay. So we always look very deeply into the business model. And obviously, because we only invest in two sectors, and most of our analysts have worked in pharmaceutical companies or have worked as doctors or have worked as lab scientists themselves and have worked in the industries and operated in those industries before transitioning into VC. We know those industries really, really well. I've built a healthcare business before. I've left the healthcare business before divested, got a liquidity event. And my business operated in 40 countries across Africa. So I know what it takes to build a healthcare business in Africa. And for our fintech operators as well, the same. So we're always trying to assess the market and saying, this might, what is the size of the market? And then after making sure that the size of the markets and the market that they're sort of going for makes sense, then we start looking at the founder and saying, what are the unique characteristics of this founder? Have they worked as an executive in this sector before? Do they have track record in terms of what starting a business before? How did that business go? What's the structure of the team and what are the unique skills of the team that they've put together? And how capital hungry is this business? Particularly in the fintech space, are they going to need licenses? Are they going to sort of need to go through compliance processes for every country that they go to, etc. So we're looking at, how flexible sort of business model is and how capital hungry it is as well. But the first thing we're looking for is this a big enough market? And I'll post my video on market size and consumption in the chat as well, because I talk a lot about really, really thinking about the market and thinking about how big the market that can buy your product is. Because, I think that a lot of people that go to build a business see a gap in the market, but there really, really, really has to be a market in the gap as well.
Perfect. Thank you. Dario, would you agree? Is it market first when you're looking at investing in founders?
I think what we've seen especially in the last couple of years is there are a lot of good companies out there, and I like what because it was saying agency strong founders. I think the concept of moat, the concept of having a specific competitive advantage is very important when building pioneering businesses across the continent, and so I think there are a lot of actually this is the point I want to make, inspired by Karen. Maybe I know making prediction and maybe explaining what I think we will continue seeing based on what we're observing is there's a whole new cycle of a whole new generation, hundreds of companies at the early stage that were not even present when the bubble happened and burst. So there's a whole new generation of companies that is out there that is reminiscent of all these lessons that have been learned in terms of being careful with valuations, being careful with which type of funding they go after. And I think this is a massive, massive, massive opportunity for the ecosystem to leap into a new chapter. One of the findings of this year's Brighter report was that the funding activity in terms of numbers at the early stage has actually kept growing over the past few years, right? Where the contraction has happened at later stage. So this actually, and also thanks to funds like Catalyst Fund, right? There's a lot of funds that now have doubled down on their cohorts, and they all are early stage, and they're looking into young companies that have just started their growth cycle, right? And so I think this represents a massive opportunity, and it's something we'll keep seeing. And ever since I've started Brighter, I've said that every year one consistent aspect that we see is the process of maturity of the ecosystem. And so I think as the process of maturity brings with it a lot of questioning of models, a lot of questionings of best practices, a lot of questionings of what was right, what is right, what's wrong, and what to do and what not to do. And so I think the new generation of companies, coupled with the new generation of early stage funds that is also specializing in very different sectors, which is something that wasn't present 5-6 years ago, plus all the hard learnings of the last couple of years, like these three factors represent an excellent cocktail to be positive about the future. However, we do need to remember that the macro conditions are still pretty wobbly, and so we'll have to be able to navigate the world, but also being conscious of the fact that there is a whole new generation of hundreds of companies that is coming to the market, and many of these companies could represent the next $1 billion or anyway the next $100 million company. I think this is a note I would like to end with on my end.
Cool. Thank you, Dario. And Karen, finally, if you could give me 3 things that you look for in founders at the Catalyst Fund, what would they be?
Yeah, sure. So first of all, we very rarely invest in a solo founder. So we usually prefer to invest where there's at least one other co-founder. And in looking at that, we look at then the complementary skill sets between the co-founders together. So if one is typically quite strong on the tech aspect of the business, then it would be important to have someone else who's very strong either on operations or the business development side of things, and the tech resource can focus on what they're strong at. So that's one, it's a complementarity between the team of founders. Another one is, of course, knowledge of what it is you're trying to execute. So relevant expertise within what it is you're trying to solve or to set up. So if you're, for example, in a health tech, it would be important to see someone at least with a medical background within the co-founding team, or something relevant in that sense, in terms of perhaps medical systems, medical records, and that someone who has an understanding of the healthcare system. If you're looking at, we have an investment in sort of very technical direct air carbon capture. He's built a team of experts who have that very technical expertise within that carbon space. So very relevant expertise is important to us. And so it's very rare as well. I think we haven't yet invested in a first-time founder, say straight out of uni, who's like really just starting off their career as a startup. So an experienced founder is another thing that we look at. There are some soft things we look at because of the model that we operate. So coachable, you can pivot when it's necessary. Very responsive, very clearly able to articulate the business that you're trying to build. And yeah, general passion and grit that you're gonna go through the hell that there is in running a startup. Yeah.
Perfect. Thank you. Guys, thank you. Thank you for your time and your valuable answers on this panel. And I would just encourage all our viewers to go back onto YouTube and rewatch this, because there were so many golden nuggets. And if you really paid attention, there was so many things. I certainly learned a lot. So thank you for that. And Nathaniel, back to you.
Like Nathan, I will take over. Thank you so much for everyone to have joined. I'm going to share now. Again, we are at Johannesburg in April. Sorry for my voice. Mark the date, 23 to 24th of April. And I'm just going to share the slide now to announce that the report is on the website. So you could go and actually download or check what we have been doing. And yeah, have a wonderful afternoon, and see you next time.
Thank you,
Bye-bye.
everyone. Have a lovely day. Bye.
Thank you.
Thank
Bye.
you. Thank you very much. Bye-bye.
All right, I'll let you guys 2-3 minutes to scan the QR code. It's also available on www.africarena.com. And we are going to just end in 2 minutes. All right, everybody, bye and have a wonderful afternoon.